I have a presentation which will end up being a little bit more of an overview rather than a research presentation. It's based on 2 or 3 papers I've written with characters that are listed on the slide. Siamak is a colleague of mine. A bunch of other people are students or collaborators in general. There will be a paper, so we can make it available, but perhaps some of the things are too involved, and I didn't know how much people knew about high-frequency markets. So what I intend to do is give you a bit of an overview, all right? So what's algorithmic trading, how it's done, and a few remarks about high frequency. And we can offline, we can talk to nauseam about that topic. So just in case you're not aware of roughly how the trading life cycle works, you can think of a portfolio manager that, let's say, rebalances a fund every 2 weeks, every month, or every quarter. When you rebalance a fund, that generates a trade list. So that's a set of orders, a set of positions that you want to sell, and a bunch of other positions that you want to get into. That list gets transmitted to a trading desk. That could be on the buy side or the sell side. Eventually, it goes into sort of the sell side, the broker that is going to execute these orders, right? And typically, these orders right now are executed through computers, right? This is what I call algorithmic trading engine, and I'm going to talk a little bit more about what that is, all right? Now, when these computers trade, they have a choice of where to trade. I mean, we tend to think that there is one market or one exchange, but there are actually about 13 exchanges, and there are about another 40 or so destinations where you can actually go and trade stock. And as such, there is a lot of choice about where to go and transact. And then when you're transacting in these exchanges, you're trading against either retail flow, and I'm going to get back to that in my last slide. You're trading against other institutional flow, and you're trading against a lot sort of market maker and high frequency trading flow. All right? And these are people that come in to trade in and out during the day. They start the day flat with no shares in their book. They may trade 100 million shares into that day, and then at the end of the day, they again own nothing. All right? So this is a simplified view of, or a caricature of what's going on. And perhaps, what I figured is we can start with an example, right? So I wasn't sure whether I was going to be the first speaker or not, but suppose we wanted to go and buy 250,000 shares of IBM from 12:30 to the close at 4 p.m. All right? So that's somebody called us and we want to execute that order. And one question would be, well, is this order large? Right? I mean, IBM is a liquid stock. Perhaps we can just get done in a second or so, right? But perhaps not, right? So the question is, how fast should we trade? When do we trade, right? How do we trade? How much do we think we're going to have to pay in order to execute 250,000 shares of IBM? All right? The price pressure that we just heard, if you're trying to buy this block of shares between now and the close, probably what's going to happen is you're going to push the price up a little bit, right? The question is how much. And the other question that I alluded to before is, who are you trading against? Right? I mean, you're buying, somebody's selling. The question is, who are you trading against and how are they behaving? All right? And the question is, how is this done in practice? So the way it's done in practice is exactly the slide that I showed you before. Right? It goes to a machine, and the machine starts trading this block over the course, let's say, of a period of time. Now let's look a little bit more on this order, and I'll show you a picture. Right? This is yesterday. So this is the black curve is some kind of smooth forecast of what we think is going to be available liquidity trading IBM shares per minute, okay, of the day. And that was a forecast, let's say, built for yesterday, okay, based on, let's say, some kind of smoothed average of 15 days or whatever you want. The red curve is what actually happened in the market. All right, so presumably there are periods, the markets are much more volatile than what you think. So in some sense, oftentimes you end up trading a lot more than your forecast. Sometimes you end up trading a little bit less than the forecast. Overall, I would say that that forecast seems like it's fitting that curve pretty well. Okay. The light green curve is the price path, okay, of the price of the IBM stock, and you can see that the swing was about $1.50 throughout the course of the day. IBM is a $200 stock, okay. So now we're going to have to trade, let's say, in the second half of the day, which is here, and the question is, when should we do it? Right? And how should we do it? Now, observation number one is perhaps if you try to trade immediately, very fast, right? There's probably not enough liquidity to get done, let's say, in a minute, or in 2 minutes, or in 5 minutes. So the question is, what's the right time scale? Right? If you look at this axis, that's 50,000 shares, right? So this black curve, which is the forecast, is hovering around 10,000 shares per minute. And I want to trade 250,000 shares, right? So if in a typical minute the market trades 10,000 shares, and I try to buy 250,000 shares next minute, I may move the price by $3. Okay? So obviously I got to spread it out, and the question is how. So forecasted volume from 12:30 to the close is about 1.5 million shares. So even if I trade throughout the course of that period, I'm still going to be about a sixth of the volume, right? So that means every 6 shares that are being traded, I'm buying one of them, which you can think of that as being fairly aggressive. The average spread for that stock is 4 pennies, right? The expected market impact, this is the expected cost of you trading, getting into that position, assuming that you're going to trade throughout to the close, is 22 basis points, approximately. Okay, these models have quite a bit of error built into them. That's 44 pennies per share. Okay, that's measurable, right? You end up paying half a dollar more per share on the average in order to execute. If you wanted to, instead of trading over 3.5 hours, trade over 1 hour, you may end up having to pay about 12 pennies more per share. Okay? Now, why would you want to do that? Well, you may actually want to trade faster if you thought that there is a possibility that the IBM stock, that the price may actually fluctuate quite a bit, right? So by spreading your order over longer periods of time, you try to become a little bit less detectable in the market, right? But the market may move because of other things, right? So you may end up buying the stock more expensively because other people were doing other stuff, okay? So you need to sort of balance this too. And the way you do that is by sort of selecting some kind of strategy, so to speak, in this algorithmic trading system that tells you how to execute this order over time. And an algorithmic trading system sort of follows this step, and I'll show you some pictures in a bit again, without showing you too many equations. But you can look at the paper for that, all right? Or the proverbial paper. So there are 3, roughly speaking, steps in executing this order. One is called trade scheduling. And trade scheduling, it takes, let's say, our horizon of 3.5 hours. We know what we want to do, and kind of sort of create some kind of plan of like how I'm going to execute this order over the next 3.5 hours, let's say splitting it into 5-minute slices. Okay? So there are different strategies that sort of go with that, and I'll show you another slide on that. The relevant time scale, if you think of what the machine is doing, right? The machine is sort of evaluating trade-offs in the time scales of minutes to hours, right? Should I do it now or 10 minutes from now, right? This is not the point where you're making sub-millisecond decisions, all right? This is about now or in half hour, now or at 3:30 when there is a lot of liquidity, now or at, into the close where sort of the liquidity picks up quite a bit, right? So these are the types of risk-return trade-offs that one does, okay? And presumably, this problem is some kind of solution of some decision models problem, but it's stochastic, dynamic, and it has a few other things there that one can think of, but it's of that variety. The next thing is you take these 5-minute plans, and now you got to go and trade it in the market, right? So I came up with a plan, and the plan says go to the market now and purchase for me over the next 5 minutes 3,500 shares of IBM. All right? So that involves taking the 3,500 share block and chopping it up into smaller blocks, right? And deciding when and where to execute by looking essentially at the state of the high frequency markets. All right? The relevant time scale here is it's seconds, right? So you're making decisions and you're revising decisions in the order of a few times a second or every few seconds, all right? This problem involves sort of analysis of the limit order book dynamics. And I'll show you, I'll tell you a little bit about what that means in a bit, and I'll show you a picture about that. And then, right at the very end, I told you that there is not one exchange, but there are 13, and there are also another 40 or so alternative trading systems. And therefore, every time you say, go and buy now 100 shares of IBM, there are about 55 or 53 destinations where I can actually go and try to do it. They differ in their economics, cost, adverse selection, all sorts of things. And we have another decision to make. And that decision typically happens in that millisecond time frame, okay? And the high frequency or dynamics of the market become very relevant in that time frame. All right? So I'll show you a few pictures, each touching on each of these sort of blocks, and or a few slides, and then I'll give you a flavor about how the dynamics of different things, including IBM, differ, right, in the market, and then I'll conclude with some comments about high frequency trading. All right. So I don't know how many people have experience in trade execution or have heard some of these names, but typically people use some kind of variety of a strategy. Popular strategy back in 10, 15 years ago is something called VWAP, volume weighted average price. So you kind of, if you were to trade IBM using a VWAP strategy, right, our order, then you would split the 250,000 shares according to that forecast, according to that black forecast that I had. So you would trade proportionally to what my forecasted liquidity was, okay? You can spread it uniformly over time, that would be TWAP. You can do some other things, right? The most sort of, not intelligent, but the most rational or perhaps way of doing it is something called implementation shortfall that measures the trade-off between the risk of the price moving away from you against the cost, which is if you trade very fast, you're going to push the price yourself, right? This is the 22 basis points we're talking about, all right? Again, one thing of interest, right? We just said that 22 basis points is 44 pennies per share, but over the course of 3.5 hours, the IBM share price yesterday moved by $1, right? So I will move the price by 44 pennies, but if I wait too long, the price may move by $1, right? So I need to sort of trade these two off, all right? So you choose a strategy, and the strategy, sort of comes up with this master schedule that I mentioned before, and then you try to execute. The way you execute is you study what you go to the exchange typically to execute, right? And exchanges today are essentially all of them electronic limit order books, all right? So these are to some extent queuing systems, all right? So there are orders to buy and there are orders to sell. These are limit orders, right? Each of these sort of columns is a queue, right, where people submit their orders, and the orders are queued in the order in which they were received in the market. all right? And this is the highest price at which a buyer is waiting. This is called the bid. And then there are also orders behind the bid, away from the bid. And then these are orders to sell, okay? The distance between the highest buyer and the lowest seller is called the spread, all right? And what happens is this picture is changing very fast all the time, right? By what? By people submitting limit orders to the various price points, okay, on both sides of the book. There are people canceling orders because they're fed up, they think the price is going to move, they change their mind, or what have you, a myriad of reasons. And I know that Larry gave a talk that he talked a little bit about cancellations, trying to explain things that people do around the flash crash that happened about 1.5 years ago. 2 years ago. And then obviously people send market orders to sell or to buy, right? That trade against resting limit orders. All right? So all of these things, you know, in the case of IBM, market orders to buy and sell perhaps come in to the market, you know, every second or every fraction of a second or every 2 seconds or something like that. Each such order is for 100 shares, typical size, and executes, let's say, a market order to buy against the top 100 shares that are here in the market, and then sort of trading evolves. Now, the real problem, of course, is that the market doesn't look like one limit order book, but it's many, right? So one needs to be deciding where to send the order, both to place orders and to execute with the market order. And this is the thing that you need to be optimizing down at the millisecond level. And sort of combining all these two, you get some sort of execution profile for the order. These are pictures. I'm going to show you 2 pictures, and then I'm going to conclude. So this is a picture that shows the 30 stocks of the Dow Jones. These are pretty liquid stocks. And it tells you, if you were to post a limit order at an exchange, how long would you wait, or in expectation, until you get it traded, okay? And what you see is, in some cases, that will be in about, this is a log scale, so 10 to the minus 1 here, that would be 6 seconds. That's in minutes, right? So that would be about 6 seconds, right? Whereas if you're trading Bank of America, you may have to wait about 10 minutes. Right? So there's a big variation between sort of the depth of the book and the speed at which the book is moving, right? And you see that the dots are all over the place. And for each security, there are multiple dots, and these represent the sort of main exchanges at which the security is trading. All right? If you want to ask yourself what's the depth of the book, right? Because one could have said, look, IBM is so liquid, perhaps there will be hundreds of thousands of shares waiting to be sold at the offer, right? So I can just go and buy 250,000 of them at the pop, right? Well, it turns out that that's not the case, because for IBM, the number of shares posted at the offer waiting to trade is of the order of a few hundred shares in each exchange, okay? So presumably you wouldn't be able to get a lot of stuff done in that way. Exchanges are coupled across, different exchanges have their dynamics are coupled, and I have a whole paper about that, but that's where we have results, okay? Markets are very stochastic, and there is something that needs to be done about that, but so who are you trading against? That's the parting thought. So their algorithmic flow, this is the things that we talked about. This tends to be what I call, this is flow that has a mandate to trade. Somebody gave you an instruction, you go and buy these shares for IBM, you have to do it, right? You tend to trade a lot against sort of market makers, these high frequency guys that are there to either provide liquidity and capture the spread, these 4 pennies in the case of IBM, or they're there to exploit short-term alpha signals. By looking at limit order book dynamics, there are many strategies about, I think now the price is going to move this way, I think now it's going to move like that, go up. And these signals have a lifetime or a lifespan of milliseconds to a few seconds, maybe a minute, okay? And then typically start and end the day without any positions, right? So presumably if we start the day and we all want to buy IBM stock, there are a lot of market makers there that are just buying and selling, but at the end of the day, they have no IBM stock holding in their hands. There's got to be somebody that steps in and sells it to us, right? A net seller. And these are typically opportunistic, price-sensitive investors. And if there is too many people that want to buy, the price eventually is going to go up. And after a time, it's going to go up sufficiently so that these opportunistic guys are going to step in and provide liquidity, right? And the market maker is out. So these are the typical participants. A lot of the models that we just described try to model how these people behave, and as a result, try to understand how to best trade against them, right? And then there is sort of a whole little ecosystem of people, models, and research that tries to look at these problems. I'll stop here, okay?